Yes, students. Now we will get into the fourth head of income, that is capital gains. Section 45 to 55 covers the provisions with respect to capital gains. Section 45 being the charging section. And before I start, guys, the most important head for your exams. Why? Because there are a lot of amendments in this head. Yes, so please be very careful. Maybe study it twice, thrice, how much ever times you can. Try to study it maximum times. Because I feel somewhere the question will definitely be targeted on this head, guys. On which topic? Because there are a lot of changes here. What exactly we will see? Everything we will see. But please be ready for any kind of questions. Yes. So section 45 being the charging section specified, any profits or gains arising from the transfer of capital asset during the previous year is chargeable to tax under the head capital gains. So for us, it is important to understand few terms. What are those, sir? Transfer capital asset previous year. Previous year, anyway, we already discussed in section 3. Whereas now we have to understand what is transfer, what is capital asset. But before we proceed further, sir, till now, what all sections we have covered? Just to give a highlight of it. So, I have given in the first page the section numbers, guys. So, you can come to that. So, till now, what all we have covered? I guess we have already discussed till section 6, which we done residential status. After that, sir, scope of total income is covered along with section 7 and 9. That is income deemed to be received, income deemed to accrue or arise in India. Then what about section 8, sir? It is a part of income from other sources, guys. That is the taxation of dividend income is covered in the head income from other sources. Then coming to section 10, which I would be covering, or I have already covered few exemptions, chapter wise, head wise. We don't have a separate chapter for it, but under the respective head, whatever is the exemption available, we would have covered it. Okay, sir. Then coming to the special exemption for charitable religious trust given under section 10, 11, 12, and also the political contributions, the political parties, whatever exemption they enjoy, and also electoral trust, which is given in section 13A and 13B, is not a part of your syllabus. So 11, 12, 13A, and 13B is not a part of your intermediate syllabus. Then coming to section 14, which classifies the heads of income into 5. The heads of income will start from 15. 15 to 17 is income from salary. 15 being a charging section, 16 gives the deduction, 17 gives the definitions. Yes, sir. 18 to 21 has been omitted from Income Tax Act, guys. Then 22 to 27 talks about income from house property, which we have covered. Each and every section is a part of its syllabus. Then 28 to 44D is a part of PGBP head. Then whatever we are seeing now, section 45 to 55 is a part of capital gains head. Then the last head of income, that is income from other sources, is covered under section 56 to 59. Okay, sir. Till here we are discussing capital gains. We are yet to discuss and income from other sources. But these are the sections up to heads of income. Now coming back to capital gains. Yes, we'll continue. Sir, if there is a transfer of capital asset, it is taxable under this head. Sir, what is capital asset? What is transfer? Capital asset is defined in section 2 clause 14, guys. 2 clause 14. What is it? We will see. Capital asset means the property of any kind held by the assessee, any securities held by foreign institutional investor, ULIP, issued on or after 1st February 2021, not exempt under section 1010D. Only if ULIP is not exempt under section 1010D, only then it is taxable here. Sir, when is it exempt under section 1010D? Is only if your yearly premium is within 2,50,000. Even if in 1 year, if you have paid the premium on ULIP policies more than 2,50,000, whether individually or in aggregate, then exemption under section 1010D is not available when the policy matures. Then automatically it becomes capital asset, and when it matures, is it a transfer? Yes. Do we compute capital gains? Yes, guys. but it does not include stock in trade, raw materials, and consumables, and personal assets of movable nature held for personal purpose. So, our personal assets and all, if I sell it, am I liable to pay capital gains tax, sir? No. Why? Because it is not at all a capital asset. It is not at all a capital asset. Then, exception. Jewelry, archaeological collection, drawings, paintings, sculpture work of art is a capital asset. Sir, are this capital asset? Yes. Whatever I have highlighted in red color, is it a capital asset? Yes. Whatever I have given in green color is not a capital asset. I know you may get confused between what is capital, what is not capital. That is why I have highlighted with a difference in color. Next, rural agriculture land, gold bonds, specified bearer bonds issued by central government are also not the capital assets, guys. Then, only if there is a transfer of capital asset, it is taxable here. Now, what is transfer, sir? It is given in section 2, clause 47. Transfer includes sale, exchange, or even relinquishment. That is when I am surrendering my right in the asset. Is it a transfer, sir? Yes. Next, extinguishment, cancellation of any right. Sir, I am cancelling my right over my asset. Is it a transfer? Yes. Then compulsory acquisition under any law. Sir, government has compulsorily acquired my land or building for road extension or highway construction or metro construction. Is it a transfer from my side? Yes. Conversion of capital asset into stock in trade. Even that is a transfer. Why? Because the asset is moving from one rate to another rate. From capital asset to PGBP. Is it a transfer? Yes. Computation and all we will discuss later. Maturity or redemption of zero coupon bond. Maturity or redemption of zero coupon bond. These are the transactions which are considered to be transfer. Okay. Then guys, section 48 talks about the computation of capital gains. So before computing the capital gains, our first task is to classify whether the capital asset is it a short term or long term. Why so? Because short term capital asset, if I have transferred, I have to compute short term capital gain. And if I have transferred long term capital asset, I have to calculate long term capital gain. And sir, any gain is gain, no sir, calculate something. No, there is a difference. For long-term capital assets and all, there is something called as indexation available. But from 23rd July, Madam has removed it. But few selected assets still available. Okay. Whereas the tax rates are also different, guys. On short-term capital gain, the tax rates are different. Long-term capital gain, the tax rates are different. So it is very much important for us to first classify whether the capital asset is short-term or long-term. How do I classify it, sir? Based on period of holding. Sir, what is period of holding? It is a time gap between the date of purchase till the date of transfer, guys. Clear? How long did I hold it before I sell or before I transfer it? So there are two set here, guys. That is, I have divided long term and capital as long term and short term capital asset. See, there are three category here: 12 months, 24 months, 36 months. Three set of assets they have categorized it. If I have held the asset, respective assets for less than or equal to 12 months, 24 months, or 36 months before the transfer, we call that asset as short-term capital asset. And when it is transferred, I need to compute short-term capital gains, guys. And short-term capital gains on the transfer of EFT. You're already familiar with this. What is EFT? Equity shares, units of equity oriented fund, units of business trust. Then it is covered under section 111A, which is taxable at 15%, or now the rate is increased to 20% from 23rd July on the entire amount. On the entire amount. And if the short-term capital gain is on the transfer of any other asset other than EFT, it is always a normal income, taxable at normal rate. It is not a special income, guys. Then coming to, sir, what if the asset is held for more than 12 months, 24 months, or 36 months before the transfer? Then we call that asset as long-term capital asset. And when it is transferred, we have to compute long-term capital gain. Now, if there is a long-term capital gain on the transfer of EFT, it is covered under section 112A. It is covered under section 112A. which is taxable at either 10% or now the rate has been increased to 12.5%, but only on the gain in excess of 1,25,000. Means up to 1,25,000 it is not taxable. Yes, sir. Sir, what if there is a long-term capital gain on the transfer of any other asset? Even that is a special income. Even that is a special income, which is taxable under section 112. At what rate, sir? 20%, or now from 23rd July, it is 12.5% on the entire amount. On the entire amount. So now if you ask me, sir, all these are special incomes? No, only three of them are special income, guys. Three of them. Whereas this is not a special income. It is taxable at normal rate as applicable to the associate, guys. Yes. Now you told, sir, what is this period of holding? 12, 24, or 36? A bit confused, sir. Where, which asset, how much, sir? We will see that. Guys, classification of capital asset into short term or long term depends on the period of holding. And the period of holding I am categorized into two categories here. That is, if the transfer has taken place before 23rd July or next 23rd July or after. Okay. If it has transfer has taken place before 23rd July, guys, that is from 1st April of our previous year to 22nd July. How do we decide whether the asset is short term or long term? So there are three set of assets, guys. You can observe your three set of assets. You have to remember them. First set, listed securities, both equity, preference as well as debt on a recognized stock exchange, unit of equity oriented fund or unit trust of India, zero coupon bond. If these three assets are held for more than 12 months long term, less than or equal to 12 months short term. Then second set, unlisted shares, only shares, equity and preference. Sir, what if it is unlisted debt? It will come here. Other than shares, please be careful. Unlisted shares, equity and preference, then land or building or both, which we also call it as immovable property, guys. For that, the period of holding is 24 months. If you have held it for more than 24 months, long term, if not short term, then all other assets, remember this too, enough. All other assets falls under 36 months. All other assets. Then why you have named a few of them? Because students might get confused. That is why I have just named a few, guys. Clear? Because what happens now? Listed shares are covered here. Sorry, listed securities are covered in first category, whereas unlisted shares only is covered in the second. Whereas any other unlisted securities other than shares will fall in last. Then units of equity oriented fund is covered in first category, whereas if it is a debt oriented fund, it will fall in last. Then units of business trust specifically I have given. Why, sir? It is a part of EFT. It is a part of EFT. In my EFT, which is covered under section 111A and 112A, guys, observe 111A and 112A covers only three assets. What are those? EFT. E and F will fall here, whereas T will fall where? Last category. Clear? So to decide whether it's short term or long term, please be careful. E and F 12 months. For T it is 36 months. Okay, sir. Now it is easy. Madam has made it easy. In case of transfer takes place on or after 23rd July, that means from 23rd July to 31st March. Sir, what is the period of holding? How do I categorize the asset? Only two categories. Remember first one, rest all will fall in second. 12, same assets, guys. Same assets. Whatever three assets were there, na, same three assets. Listed securities other than unit on a recognized stock exchange, unit of equity oriented fund or unit of unit trust of India, or zero coupon bond. Zero coupon bond. Same three assets which had 12 months here, same 12 months here also. Then all other assets 24 months, guys. If held for more than 24 months long term, less than or equal to 24 months short term. That means on or after 23rd July, they have clubbed both of this. They have clubbed both of this and they have made 24 months. So before 23rd July, three set of assets. On or after 23rd July, two set of assets, guys. Next, there are three assets which are covered under section 50AA, guys, for which we always compute short-term capital gain or short-term capital loss. Which are those assets, sir? units of specified mutual fund acquired on or after 1st April 2023, then market linked debentures, and now one previously these two were there, now one more addition. Unlisted bond or unlisted debenture which is transferred or redeemed or matures on or after 23rd July. On or after 23rd July. Yes, sir. There's an addition. Please be careful. Only if it is transferred on or after 23rd July, it will come here. Sir, what if it is transferred before 23rd July? Decide based on period of holding. Decide based on period of holding. Okay, sir. You helped me to understand whether the asset is short term or long term. Now, if I have transferred short term asset, how do we compute short term gain, sir? The format is given in the law. First, you take full value of sale consideration, which is nothing but the sale value. But if by chance, if sale value is not available, guys, then we may end up taking FMV or stamp duty value. Then expenses on transfer, that is at the time of sale, any expenditure I would have incurred like commission, brokerage, anything like that. Then we get net sale consideration. Then cost of acquisition, which I would have incurred to purchase the asset, reduce it. Then once I have purchased the asset, if I have incurred any capital expenditure to improve that asset, claim it. Sir, can I claim both? Yes. Then you will get gross short-term capital gain, from which if you are ready to reinvest in a new asset under section 54B or 54D, you will get the exemption. Next, you will get taxable short-term capital gains. Guys, if by chance, while computing capital gain, if the question is silent about exemption, both while calculating short-term as well as long-term, ignore the exemption. Straight away in that case, gross will become taxable. Gross will become taxable. Sir, how do I compute long-term capital gain when there is a transfer of long-term capital asset? Same format, but for long-term assets, they are giving something called as indexation. Clear up for both cost of acquisition as well as cost of improvement, as the asset would have been purchased long back. To adjust the cost of inflation, government has released something called as cost inflation index, CII. Using that, I can claim indexation for both cost of acquisition as well as cost of improvement. Okay, so rest all remains same. Then we will get gross long-term gain. From that, we have number of exemptions. Whereas for short term, we had only 2 exemptions. Whereas for long term, we have 54, 54B, D, EC, and F, provided you are ready to reinvest the amount of capital gain in the new asset. So that will give you taxable long-term capital gain, guys. Then coming to year of chargeability. Normally, generally, capital gains is taxable in the year in which transfer took place. Transfer took place, but there are few exceptions for it. Means the transfer would have taken place in 1 year, but it will become taxable in some other year. Sir, which are those? One by one. Some exception to the rule. Normal rule is what? Capital gains shall be chargeable in the previous year in which transfer took place. But there are certain exceptions for it. What is it? First one. Insurance compensation received on the destruction of an asset is taxable when it is actually received. Transfer takes place in the year of destruction, but it is taxable in the year in which the compensation is received. Sale value would be what? Value of money received. If the insurance company paid me the money, or if they give me the new asset, then the value of that new asset will be the full value of sale consideration, guys. Let us just discuss one question on it. Okay, one example. Yeah, you can see illustration. Capital asset was purchased on 20th September 2018 for 10 lakh, and it got destroyed by fire on 22nd May 2022. So transfer took place in which year, guys? 22, 23. And insurance compensation of 6 lakh was received on 30th July 2024. So compensation was received on which year? 24, 25. So please be careful. Here, transfer took place in the year 22, 23. So period of holding and indexation is only till when? 22nd May 2022. That is the year of transfer. Whereas when will it be taxable? In the year 24, 25. So CIA also I have given for 18, 19, 22, 23. And for our year, you have to remember it. Okay. Anyway, for this question or illustration, it is not important, but still For our previous year, sir, what is the cost inflation index? For our previous year, what is the cost inflation index? 363, which is our previous year, 24-25. Normally, the year of transfer for calculations will be, the year of transfer would be 24-25, guys. Okay, so coming back. Okay. So transfer took place in the previous year 22-23, but capital gains will be taxable in the previous year 24-25. That is the year in which compensation is received. Period of holding is from 20th September 2018. That is the date of purchase. Till when? Till the date of destruction. Because transfer happened in 22-23. The period of holding as well as indexation also will stop there. But it becomes taxable in the year in which it is received. Sir, can I claim period of holding and indexation up to that? No, no, no. Okay. Capital gains taxable in the previous. And is it a long term, sir? Yes. Which asset is that? They are not mentioned. Okay. But still, I guess it will be more than 36 months. Yes. So any asset, it is long term. Any asset, it is long term. Okay. So full value of sale consideration. How much did they give? 6 lakhs, sir. Only 6 lakh. Sir, what if they give new asset? Take the fair market value of it. That's all. Then index cost of acquisition would be how much, sir? What is the actual cost of purchase? 10 lakh. Into, for the year of transfer, that is 22-23. What is the cost inflation index? 331. 331 divided by, for the year of purchase, cost inflation index for the year of purchase is 280. 280. How much do you get? Sorry? Huh? 143. So we have a loss of 5,82,143. Long-term capital loss. Sir, can we have a loss? Yes, under the head capital gains, we can have a loss. And the treatment of loss, we will understand later. Clear? Yes. Because normally, especially when there is a destruction of asset and all, insurance company may not pay you fully. Okay, you may have a chance of loss. Okay, sir. Next, conversion of capital asset into stock in trade or stock is taxable in the year in which stock is sold. Sale value is equal to what? FMV of the capital asset on the date of conversion. However, the period of holding and indexation is up to the year of conversion. Guys, listen here. I will explain this with an example. Listen, listen, listen. Now, sir, I had purchased a capital asset, sir, for 2 lakh in the year 1920, sir. Now I am converting this into stock, sir. I am assume I had purchased furniture, which is a capital asset. Now I have started dealing with furniture. I started the dealing of furniture in my business. So what it becomes? Stock to me. Okay, sir. When did you convert? Assume in 21-22. And on the date of conversion, the FMV of the asset was, that is the capital asset was, assume 2.5 lakh, guys. 2.5 lakh. And the stock is sold for sale value 3 lakh. When, sir? When is it sold? In 24-24, you guys assume. In 24-25. Guys, come on. Now, when there is a conversion of capital asset into stock, is it a transfer? Yes, sir. Is it a transfer? Yes. Should we compute capital gains? Yes, we have to compute. So what is the year of transfer, sir? Year of transfer would be 21-22. So indexation and the period of holding will be till when, sir? The date of conversion. Date of conversion. So period of holding will be exactly from year to year. The date means, especially to calculate period of holding, date also should be known, but I have just given the year here. That's okay. So you have to count only from 1920 to 2021. So should I compute capital gains? Yes, do the computation. But when am I liable to pay tax on the capital gains income? In the year 24-25. That is when the stock is sold. When the stock is sold, guys, we have to compute PGBP income also. We have to compute PGBP income also. So what is the sale value there? 3 lakh. And what will be the cost is the FMV. FMV. How much is that, sir? 2.5 lakh. Remaining 50,000 is which income? Which income? PGBP. When is it taxable? 24-25. Likewise, same way we have to compute capital gains also, guys. Full value of sale consideration would be what? FMV of the asset on the date of conversion. How much is that? 2.5 lakh. From that, what was the cost of the asset? Reduce it. Cost of acquisition. Okay, and if it is a long-term asset, you can claim indexation also. You can claim indexation also. Hope you guys are getting it. Clear? So whatever capital gains you get, whether short-term or long-term, along with PGBP income, will be taxable in which year? 24, 25. That is the year in which the stock is sold. Okay, so let us have a discussion on illustration on this topic. Capital asset was purchased on 20th September 2022 for 20 lakh and it is converted into stock on 25th June 2023. Year of transfer. Year of transfer 23-24. When the FMV of the capital asset was 22 lakh and such converted stock was sold for 25 lakh in which year? 25th August 2024. So that means year of taxability will be what, guys? 24-25. So you can see here transfer took place in the previous year 23-24, but it is taxable in the year 24-25. That is the year in which such converted stock was sold. Period of holding will be from 20th September 2022, that is this date, till the date of conversion, that is 25th June 2023. So it will be a short-term asset, guys. Short-term asset. So full value of sale consideration is how much? Full value of sale consideration is fair market value 22 lakh. Yes, sir. Cost of acquisition, as it is a short term, I am claiming only the cost, which is 20 lakhs. Sir. How much is the gain? 2 lakh. It is a gain in the year 22-23. But is it, sorry, 23-24. It is a gain in the year 23-24. But when is it taxable? 24-25. So business income is how much, guys? So stock is sold for 25 lakh. So 25 minus the FMV on the date of conversion, which is allowed as cost. Remaining 3 lakh will become PGBP income. Sir, are this both taxable in the year 24-25? Yes, guys. Both will be included in the total income calculation for the assessee for the previous year 24-25. Yes, sir. The last case. Compulsory acquisition of capital asset is taxable in the year in which compensation is first received. That is, if you are receiving it in installment, whenever you receive the first installment, entire amount will be taxable for you. Sir, again, when I receive second, third installment and all, will they tax it? No, no, no. Because when you receive the first installment itself, full compensation amount will be considered as full value of sale consideration. Full value of sale consideration. So what is the full value of sale consideration here? Compensation received or to be received. However, the period of holding and indexation will be only up to the date of compulsory acquisition. Compulsory acquisition, guys. Yes. And see, in all these three cases, sir, as I am getting the money later, now in exemption chapter, we have some time limit to invest or reinvest in the new assets now, like 6 months, 12 months, 2 years and all. So the time will start from the date of transfer or from the date I receive the amount, sir. From the date I receive the amount. In all the exemption sections, that is 54, 54B, D and all, they would have given the time limit to purchase the new asset. 6 months, 1 year, 2 year and all. Normally the time limit is from the date of transfer. Yes, sir. Regularly it is from the date of transfer. But in these three special cases, as it is taxable when the amount is received or when the stock is sold. So the time given under section 54 series will start from date of transfer or from the date I have received it. From the date I have received it. Clear? Yes, sir. One illustration even on this. Compulsory acquisition. Land was purchased on 20th May 2015 for 50 lakh and it was compulsorily acquired by government on 12th June 2022. So year of transfer is 22-23. And compensation of 75 lakh was received on 20th July 2024. So which year it is taxable, guys? 24-25. Cost inflation index for the year 2015-16, 22-23 is given. Yes, sir. transfer took place in the previous year 22-23, but capital gains will be taxable in the previous year 24-25. Now you may also get a doubt. Sir, if the transfer happened in 24-25, that too after 23rd July, no indexation, no sir. Guys, please be careful. All this asset transfer took place already in the past year. Clear? Madam has told only if the transfer happens on or after 23rd July, no indexation. Anta. So here, whatever special cases we are covering, transfer didn't happen in our previous year. It had already happened. We are taxing it in the previous year. Why? Because the amount was received in the previous year. Okay, so the period of holding is from 20th May 2015 to 12th June 2022. Long-term asset. Guys, if by chance if question is silent about the capital asset, which capital asset they are not considered, always go with, if the transfer is before 23rd July, go with 36 months. If the transfer is on or after 23rd July, go with 24 months to decide whether it is long-term or short-term. They have to give the what is the type of capital asset in the question, but if it is not given, if it is not given, go with 36 months if the transfer is before 23rd July, or if the transfer is on or after 23rd July, go with 24 months. Okay, sir. Full value of sale consideration is how much? 75 lakhs, sir. 75 lakh. Index cost of acquisition. Sir, we had purchased the asset for 50 lakhs, sir, into cost inflation index for the year of transfer 331, year of transfer. Please be careful. Divided by the cost inflation index for the year of purchase, which is 254. Can you please give me the number? Chinmay, tell me. 748, sir. 748. So 9,84,240, 252. 252. Taxable long-term capital gain. If the question is silent about exemption and all, I have told you, ignore it completely. Ignore it completely. Yes, guys, coming back. Coming back. Points on computation. Sir, first, in the format you taught us, after full value of sale consideration, we will reduce expenses on transfer. What is it, sir? Expenses on transfer means the expenditure incurred only and exclusively in connection with the transfer, like brokerage, stamp duty, registration fee, legal expenses, etc. But securities transaction tax is not allowed as an expenditure, guys. Under the capital gains, securities transaction tax is not allowed as expenses. Next, coming to index cost of acquisition. First of all, what is cost of acquisition? The capital expenditure which I have spent to purchase the asset. To purchase the asset. But if the asset is long term, I can claim indexation. When we are checking the indexation for long term asset, we have to check when the asset was purchased. If the asset is purchased before the base year. Sir, what is base year? Guys, for capital gains hit, the base year is considered to be 2001-2, for which the cost inflation index started. So cost inflation index for 2001-2 is 100, whereas our previous year, that is 24-25, it is 363. Sir, do we have cost inflation index only for 2 years? No, for every financial year we have it. But are you guys supposed to remember it? No. From exam point of view, for this 2 years you remember, and if by chance, if question requires us to know the cost inflation index for any other year, it will be given in the question. It will be given in the question. So that is why I have given only for 2 years. Every year cost inflation index is there, but I have given it only for 2 years. Sir, this 2 years should we remember? Yes. Okay. Now coming to, if the asset was acquired before the base year starts, guys, that is before 1st April 2001, we didn't have indexation. So what they are telling is cost of acquisition is your actual cost or the FMV as on 1st April 2001, whichever is higher. Whichever is higher. Okay, sir. I will take it. And on that, apply indexation. On that, you apply indexation. For example, assume my actual cost is 10 lakh. FMV is 12 lakh. We will take whichever is higher, 12 lakh. On 12 lakh, apply indexation. Clear? So cost inflation index numerator would be for the year of transfer. Always it will be more. Numerator will always be more, guys. Yes. So for the year of transfer, and normally the year of transfer will be our previous year, guys. 24, 25. and the cost inflation index for the base year will be the denominator, which is 100, which is 100. But this concept of FMV comparison and all is not applicable for intangible assets. For intangible assets, we will straight away take only actual cost. No FMV comparison. For my intangible asset is purchased before 1st April, sir, it's okay. Take only actual cost. Take only actual cost. Then, if land or building is acquired before 1st April 2001, then we will not consider only FMV. We will also take care of stamp duty value. There are two-step calculation there. Simple, guys. First, compare FMV and stamp duty value of the land or building as on 1st April and take whichever is lower. Compare that with actual purchase cost. Take whichever is higher, which you will get it as cost of acquisition. On this, you apply indexation. Numerator would be what? Cost inflation index for the year of transfer divided by cost inflation index for base year. Why base year? Because we have purchased it before the base year. And guys, whenever you are calculating indexation, one thing you keep in mind, index cost will always be more than actual cost. That means when you are multiplying, numerator should be more than denominator. Because by mistake, you may interchange the position. There itself, you slap yourself once and correct it immediately. Clear? So while calculating indexation, the numerator should be more than denominator. Next, for the assets acquired on or after 1st April 2001, how do we compute cost of acquisition? No comparison of FMV here. Straight away take actual cost as your cost of acquisition, then multiply that with cost inflation index for the year of transfer divided by cost inflation index for the year of purchase, not base year, because we have already purchased this after the base year has started. Clear? Yes. And indexation benefit is available only for long-term capital assets. But from 23rd July, they have removed it. It is available only for land or buildings sold by resident individual or HF. For any other asset, indexation is not available. There also, there is one catch. How is it? What is it? I will cover it later. Okay. And for the following assets, even though they are long-term, guys, still the indexation is not applicable. Indexation is not applicable. Sir, it is transferred before 23rd July, sir. No problem. No indexation. Which are those assets? Long-term capital gain under section 112A, which is EFT. Na? It is long-term, but no indexation. No indexation for this. Next, long-term capital gains from the transfer of bond or debentures. For bonds or debenture, even though they are long-term, no indexation. But indexation is available for capital indexed bonds and sovereign gold bonds. But if sovereign gold bonds is redeemed by individuals, it is actually exempt. It is not at all a transfer. By anyone else, yes, it is a transfer. Is indexation available? Yes. Then capital gains on depreciable asset. That is when section 32 fails, immediately section 50 will take over. We will always compute short-term gain or short-term loss there, guys. We don't even check the period of holding there. We don't even check period of holding. Even while computing the capital gains under section 50 AA, it is always short-term in nature. Sir, should we check the period of holding? No. For whatever gain you compute under section 50 and 50 AA, guys, don't even worry about period of holding. They are always short-term in nature. And they are normal income, taxable at normal rate, not a special income. Not a special income. Yes, sir. Now coming to cost of improvement. Cost of improvement means the capital expenditure which I would have incurred after the asset is purchased, if any. So, cost of improvement, if it is incurred before 1st April 2001, shall be nil, guys. Shall be nil. Why, sir? It will make sense because, guys, if I have incurred cost of improvement before 1st April 2001, it is understood property also I have purchased before 1st April 2001. Na? Agree? Yeah? Now listen. Assume I had purchased a land, guys, in 1995 for 2 lakh. And in this land, now I have constructed building in 1998 by incurring a cost. This is 2 lakh and this is by incurring a cost of 10 lakh. Now I have sold this asset in our previous year 24-25. When I have sold, we have to compute capital gains. We have to first check what is the cost. What is my actual cost? What is my actual cost? Cost of acquisition, 2 lakh. Cost of improvement, 10 lakh. Correct, guys. So while applying indexation for cost of acquisition, what I would have done? Listen here. 2 lakh, I will compare with FMV of the property, not only land. FMV of the property. FMV of the property includes land as well as building up. Yes. So this FMV, whatever we calculate, will be for both land and building. Assume this is 20 lakh. So what do I do? 2 lakh or 20 lakh, whichever is higher, we will go with 20 lakh. So already improvement is taken care here. Because whatever is the value of the property on 1st April 2001, everything would have been considered while calculating FMV. So again, if they give me the benefit of claiming cost of improvement, it will be a double benefit for me. It will be a double benefit for me. That is why they told, if you have incurred any improvement cost before 1st April 2001, ignore it. Ignore it because it would have already been taken care in FMV calculation as on 1st April 2001. Is it making sense? Is it making sense? Yes. Shall we'll move forward. Cost of improvement incurred on or after 1st April 2001 shall be actual capital expenditure incurred in taking additions or alterations. That is the renovations, everything. Even if it is the capital in nature only. If the capital asset is goodwill or right, the cost of improvement can never be taken. Means it will always be nil, guys. Sir, what if the asset is long term? Can I claim index cost of improvement? Yes. How is it? Cost of improvement into cost inflation index for the year in which the asset is transferred divided by the cost inflation index for the year in which improvement took place. Improvement took place, guys. Indexation is not available if the transfer takes place on or after 23rd July, except land and building transferred by resident individual or HUF, guys. Yes, sir. Next, we have cost of acquisition. Guys, normally cost of acquisition means what? The price what I have paid to purchase the asset. But there might be some special cases where cost of acquisition might be something else, like cost of acquisition to the previous owner or previous asset and all. So what is it? We will discuss now. Cost of acquisition means normally what? My expenditure which I have incurred to purchase the asset. Okay, sir. But before this, guys, there are list of transactions which are given in section 46 and 47, which are not regarded as transfer. Actually, in the real world, they are transfer. But for capital gains purpose, they are giving that the following transactions are not a transfer. When it is not a transfer, should we compute capital gains? No. So they have given the list of transactions under section 46. 46 only has one item, whereas many others are being considered under 47. Sir, which are those, sir? One by one. See, everything in detail I will not be going, but few points definitely where you will require my help. I am helping you out by explaining it. Yes. So transaction not regarded as transfer. Distribution of assets by a company for the shareholders on liquidation. Now listen. Listen, each of them I will try to explain with an example quickly. Be attentive, guys, because I will be going little faster. Yes, sir, A Limited got liquidated. A Limited got liquidated. Now they are distributing the asset to Mr. A. They are distributing capital assets of the company to Mr. A. Instead of selling it and giving the money to him, they are giving the asset itself. Sir, is it a transfer? No. Should we compute capital gains? No. Now, when Mr. A sells this asset later, if he transfer this capital asset later, is it a transfer? Yes. Should we compute capital gains for him? Yes. What will be the cost of acquisition for him? What would be the cost of acquisition for him? The FMV of the asset on the date of receipt. On the date of receipt. Guys, listen here. When A Limited distribute the asset, who is the transferor? A Limited. For them, it is not a transfer. We will not compute capital gains for them. We will not compute capital gains for him. Now listen. For the shareholder, is it an income? Yes. What did he transfer? Shares. He would have surrendered the share? Yes. Is it a transfer for him? Yes. Should we compute capital gains for him? Yes. What is the full value of sale consideration? The FMV of the asset which he has received. Or if he has received money also, even that we will take care. But the consideration to the extent of accumulated profit will be deemed dividend. Now assume company gave the asset worth 50 lakh. Company had an accumulated profit of 20 lakh. So in 50 lakh, 20 lakh is deemed dividend. 30 lakh is full value of sale consideration to compute capital gains. Is that clear? Yes, sir. Now Mr. A received the asset. When he received the asset by surrendering the share, it was a transfer for him. Tomorrow, if he transfer the asset which he received from the company, if he transfer the asset which he received from the company, is it a transfer? Yes, it is a transfer. Should we compute capital gains? Yes, we have to compute it. Sir, what is the cost of acquisition? FMV, guys. FMV of the asset, which was considered to compute sale value now. Same thing will become cost of acquisition when you sell this asset in the future. In the future. Just so. Next, all these are connected. I am trying to cover it in one place. Next, sir. Transfer of capital assets. Sorry. Transfer of capital asset in total or partial partition of HF. Guys, HF got partitioned. HF got partitioned. Now they are distributing the assets to their members. M1, M2, M3. They are distributing the assets. Sir, when assets are distributed by HF to their members, is it a transfer, sir? No, it is not a transfer. Should we compute capital gains, sir? No, we should not compute capital gains. But if this members sell this capital asset in the future, is it a transfer, sir? Yes. Should we compute capital gains, sir? Yes. Listen now. What is the cost of acquisition for them? Cost to the previous owner. Who is the previous owner? HF. That becomes the cost to the member. And what is the period of holding here, sir? Period of holding will include HF period of holding plus the members. Plus the members. How long did they hold? The period of holding of the previous owner plus the present owner. Both we have to take it. Both we have to take it, guys. Okay, so next. There is a small amendment in the third point. Transfer of capital assets by an individual or HF. Only two set of people they have covered. Under a gift, will, or irrevocable trust. Previously, the naming of person was not there. Now only individual as HF give a gift or will or irrevocable trust. It is not a transfer. But this exception or this is not applicable for ESOP shares. Now I was working as the employee of Infosys Limited. I had received the shares of the company under ESOP. I gifted that to my children. Is it a transfer? Yes. Sir, I am an individual. Yes. For ESOP shares, exception is not applicable. Is it taxable? Yes. Now listen, guys. Same story like HEF partition only. Same story. Sir, my father gifted me a property. Or anyone. Need not be always father. Anyone. Okay. Or anyone. Gifted me a property. Assume for Vikas. Is it a transfer? No. Should we compute capital gains? No. Tomorrow, if Vikas sells it, is it a transfer? Yes. Should we compute capital gains? Yes. What is the period of holding? Will include both. Period of holding of the previous owner as well as Vikas. Then, sir, what is the cost of acquisition for Vikas? Cost of acquisition to the previous owner. What is the cost of acquisition for Vikas? The cost to the previous owner. Yes, sir. Next, transfer of capital asset by a holding company to wholly owned subsidiary company or vice versa, provided the transferee is an Indian company. When assets are transferred from wholly owned subsidiary to holding or holding to subsidiary, it is not a transfer, provided the receiver is an Indian company. Provided the receiver is an Indian company, guys. Next, amalgamation as well as demerger, both are covered. So I will take the example for amalgamation, the Maruti Motors and Suzuki. You know, they got amalgamated long back, not today or yesterday. Guys, Maruti Suzuki got amalgamated with, sorry, we will make it like this. Maruti got amalgamated with Suzuki and they named it as Maruti Suzuki. Maruti got amalgamated with Suzuki of Japan and they named the entity as Maruti Suzuki. Now, sir, all the assets of Maruti will be transferred to Maruti Suzuki. Na? So, all the assets have been transferred. Is it a transfer, sir? No. Should we compute capital gain, sir? No. Provided Maruti Suzuki is an Indian company. Provided Maruti Suzuki is an Indian company. Okay, sir. Next, listen here. Sir, if these assets are sold by Maruti Suzuki in the future, what is the cost to them? Cost to Maruti. Period of holding will include period of holding of Maruti Suzuki plus the period of holding of Maruti. Both. Clear? So, period of holding will include for both Maruti plus Maruti Suzuki. Maruti Suzuki. Yes, sir. Cost of acquisition would be for Maruti. Got it? Yes. Next. I was the shareholder. Vikas was a shareholder in Maruti. Now his share in Maruti was taken back and the shares in Maruti Suzuki was given. Is it a transfer for him? No. His shares in Maruti was taken back and in that place shares of Maruti Suzuki was given. Is it a transfer for him? No. Should we compute capital gains? No. Now, if these shares are sold in future, is it a transfer, guys? Yes. Should we compute capital gains? Yes. But did he purchase the shares of Maruti Suzuki? No. Which shares he had purchased? Shares of Maruti. What is the cost of acquisition of that? Will become the cost of acquisition of Maruti Suzuki. I didn't purchase it in open market, but still, whatever I had paid to purchase the shares of Maruti will become the cost of acquisitions of shares of Maruti Suzuki. Hope you guys got it. Yes, sir. Next, same scenario. What if it is demerged? Done with amalgamation. Okay, it is more of merger. Now we are getting demerger. Marriage or divorce. Now, Reliance Industries Limited demerged one of its business as JFS. JFS, that is Geo Financial Services. Hope you guys are aware of. Yes, sir. It is demerged. It is demerged. Now, guys, few of the assets of Reliance Industries based on the percentage of demerger. Let us take it as 5%. It was some 4 point some decimal, but let us take it as 5% demerger percentage. 5% of all the assets of Reliance Industries will be transferred to Geo Financial Services. Yes, sir. So, is it a transfer, sir? No. Should we compute capital gain, sir? No. Now, future, provided JFS is an Indian company. Provided JFS is an Indian company. Tomorrow, if JFS sells this asset, is it a transfer, sir? Yes. Should we compute capital gains, sir? Yes. What is the cost of acquisition, sir? This asset at what price it was purchased by Reliance Industries? That is the cost of acquisition for JFS. And will period of holding includes both? Yes, it will include both. Did you guys get it? Yes. Now, assume Vikas was the shareholder. Sir, in every company you are holding, yes, let us assume, Vikas was a shareholder in Reliance Industries Limited. They will not take back the shares of Reliance Industries for me. Now they will give for every shareholder who is holding the shares in Reliance Industries, they will give the shares of JFS. And the ratio and all, company will fix it, guys. Company would fix it. Okay. You need not worry in what proportion for every one share, two share, one share. That ratio and all will be fixed by the company based on the valuation of the demerged company. Okay. So this is called demerged company, guys. This is called resulting company actually. Resulting company, JFS. Now, Vikas got the shares of JFS. He didn't give back the shares of Reliance Industries. So, is it a transfer? No. Now, for shares of JFS, did I pay anything? No. But what would be the cost? Assume, guys, I have purchased the shares of Reliance for 1000 rupees. What is the ratio of demerger? 5%. So, 5% of this will be the cost of acquisition for what? JFS. Remaining 95% will be now my cost of Reliance shares. If you guys are really interested in investing and if you are associated with it, you will understand. Automatically on the record date, the share price of Reliance also will get adjusted. It will get corrected by 5%. approximately. Why so? Because the ratio of demerger is 5%. Now, whatever might be the price of Reliance, it will get corrected by 5% because it is going to JFS. JFS. Hope you guys got a clarity. Yes. Oh, so that is all about, guys. If asset is transferred also, see this 2 points is about assets. Next two points is about shares. If shares are transferred from one person to another person due to amalgamation or demerger, sir, is it a transfer? No. If capital assets are transferred from one company to another company, is it a transfer? No, provided the receiver is a Indian company. Okay, sir. Next, transfer made outside India for of any government security by one non-resident to another non-resident. Sir, one transaction is happening outside India, sir. One non-resident is transferring to another non-resident. What, sir? Our government security, like bonds issued by Indian government and all. They are telling it is not a transfer. It is not a transfer. Okay. Next, redemption of sovereign gold bond by an individual. One of the very good investment to invest in digital gold, but government discontinued this. The fresh issue of sovereign gold bond has been discontinued. But whatever issue has already been made, definitely they will be redeeming it. Okay. Next, conversion, transfer by way of conversion of preference shares into equity shares, or transfer by way of conversion of bonds or debentures, debenture stock, debenture certificate into equity shares or debenture of that company. You guys would be aware of convertible debenture, convertible preference shares and all. When it was issued, it is issued in the form of preference shares, debentures. But later, the shareholder or the debenture holders will be given the option to convert it. Let me just put an example for this. Listen, guys. Sir, I had purchased the preference shares of the company for 1 lakh rupees. I held it for 2 years. I am seeing. I held it for 2 years. Later, I converted this into equity share. Is it a transfer, sir? No. Should we compute capital gain, sir? No. Conversion of one form to another form, not a transfer. But please be careful. Conversion of capital asset into stock is a transfer. I am not talking about that here. Conversion of preference shares into equity or debenture stock into equity, something like that. Oh. Now tomorrow, I held this, assume guys, equity share also for 1 year and I am transferring it. I'm selling it. Is it a transfer? Yes. Should we compute capital gains? Yes. What would be the period of holding? Period of holding of preference shares, that is 2 years, plus period of holding of equity share, 1 year. Then what would be the cost of acquisition? Cost of acquisition of preference shares, which is 1 lakh. So indexation also, is it available for full 3 years? Yes, guys. Hope you guys got it. Next, any transfer of capital asset in a transaction of reverse mortgage under a scheme made notified by the central government. Reverse mortgage is a financial arrangement which is offered by the bank to age-old people, under which age-old people can pledge their or mortgage their house properties or property and take a loan, and they need not repay it. And they need not repay, including interest, they need not repay it. That means, what about the bank, sir? When the senior citizen dies, they will take the assets. They will take the asset. Asset belongs to whom? Bank or financial institution. Now, when bank or financial institution take the ownership of the asset when the age-old people dies, is it a transfer? No, it is not a transfer. Okay, sir. Next, any transfer of a capital asset being conversion of gold into electronic gold receipt issued by old manager, or a conversion of electronic gold receipt into gold. Again, one more case. How many cases? I'm trying to connect for all. One case I will take, connect all. Period of holding, cost, everything. Now listen. I had purchased 50 grams of gold. ಎಷ್ಟು cost ಈಗ? 50 grams of gold. 4 lakh change. Okay, let me make it 5 lakh. Round off. Now, ಧಾರಾಳ ತುಂಬಾ. So 5 lakh we will make it. My cost of purchasing 50 grams of gold. Hey, 50 grams. ಕೂತ್ಕೊಳ್ಳೋ, straight ಆಗಿ ಕೂತ್ಕೊಳ್ಳೋ. 50 grams gold ಬಗ್ಗೆ ಮಾತಾಡ್ತೀನಿ ನಾವು ನೋಡಿ ಮಲಗಿದ ನಾನು. So 50 grams gold I had purchased for 5 lakh. Now I want to keep it in a digital form. Sir, not safe to keep it at home, sir. So many robbers are there here and there in everyday news channel. If I watch, then I am getting scared, sir. So I went and approached old manager. Old manager. I gave my physical gold to him and he gave me the, okay, Vikas. I gave my physical gold to him and he gave me digital gold in the form of electronic gold receipts, which is equivalent to what? 50 grams, which is equivalent to 50 grams. Now, this electronic gold receipts, can I sell it in the open market? Yes, I can sell it. If I sell it, is it a transfer? Yes. Should we compute capital gains? Yes. But I gave physical gold and he gave me the electronic gold receipts. Now, for both of us, is it a transfer? No. Should we compute capital gains for it? No. No, no, no. Now, what do I have? Electronic gold receipts. Now, I told if I sell it in the open market, it is a transfer for me. What would be the cost of acquisition? Cost of acquisition of physical gold. How much it was? 5 lakh. 5 lakh. Hope you guys got it. Next, sir, I went back to him. I felt my relations are not respecting me without gold. Give back my gold. I want to wear it. I want to use it, or I want to showcase in my home. Anta. So I went back to the old manager itself. I didn't sell it in the open market. I went back to the old manager and I told, sir, I will give back your electronic gold receipts. Give me mine, physical gold. Physical gold. Is it a transfer, guys? No. Do we compute capital gains for it? No. Now, what do I have? What do I have? Physical gold. What is the cost of it? Because if I sell in the future, physical gold it is taxable. Yes. What is the cost of it? 5 lakh. Guys, it is like a cycle. Simple. Listen here. I purchased physical gold for 5 lakh. I gave it and got electronic gold receipt. What do I have now? Electronic gold receipt. What is the cost of it? 5 lakh. I gave back electronic gold receipts and got physical gold back. What is the cost of it? 5 lakh. Is that clear? So whatever I give and get back, the value of that will become my cost. When I gave physical gold and got electronic gold receipts, what was the cost of asset which I gave? 5 lakh will become the cost of asset which I took. Next, I gave electronic gold receipt. What was the cost of it? 5 lakh. And I got back what? Physical gold. Now, what is the cost of physical gold? 5 lakh. 5 lakh. Hope you guys got it. Last one. Transfer of capital asset being work or art, scientific or archaeological collection, books, manuscripts, paintings, drawings, etc. Provided the transfer is to a government or the university or the National Museum, National Art Gallery, National Archives or any other public museum or institution notified by the central government. Only if the transfer is to the selected people, they are telling it is not a transfer, guys. Yes, sir. Now coming back to our cost calculation. Cost calculation, guys. Goodwill, if it is self-generated, cost will always be nil. If it is purchased, whatever is the purchase price. Then if stock is converted into capital asset, guys, listen. We learned in capital gains head, if capital asset is converted into stock, it is a transfer. Yes. Now listen, please. I will explain both. Listen. Interesting. Pay attention, be attentive, listen this. Both the stories I will try to connect. If stock is converted into capital asset, it is taxable under the 8 PGBP. What is taxable, sir? FMV of the stock on the date of conversion. On date of conversion will be taxable under which head? PGBP. PGBP. Sir, tomorrow if I sell this capital asset, what is the cost of acquisition, sir? FMV. FMV. Which FMV, sir? The FMV which was taxable under the head PGBP will now become the cost under the head capital gains. This is from PGBP as well as capital gains point of view. The starting point was where? PGBP. Ending point would be under capital gains. Same way, capital gains head told. You are taxing when asset is moving from PGBP to capital gains. Let me also tax. When the asset is moving from the capital gains head to PGBP. That is, if capital asset is sold, where is it taxable, guys? Capital gains. But if stock is sold, where is it taxable? PGBP. So capital gains head we told we will consider it as transfer. We will consider it as transfer. So what would be the full value of sale consideration to compute capital gains income? It is FMV of the capital asset on the date of conversion. On the date of conversion. What would be the cost of acquisition? Actual cost. Whatever you have incurred to purchase the capital asset. Yes, sir. And when stock is sold, the sale value we will take. From sale value, we will reduce FMV as a cost. Which FMV? The FMV which I would have taken to calculate the capital gains income. So here we will get what income? PGBP. Here what income will we get? Capital gains. But both the incomes are taxable in the year of sale of stock. In the year of sale of stock, which we already discussed. Guys. Is that clear? Yeah. When stock in trade is converted into capital asset, fair market value of the stock on the date of conversion will be the cost of acquisition. Next, when the asset become the property of the assessee on gift, will inheritance distribution of assets of each of on partition, amalgamation or demerger. What would be the cost? Cost to the previous owner. Sir, what if the cost to the previous owner we cannot calculate or is not available? Then take the FMV on the date on which the capital asset become the property of the previous owner. Approximately, even if exact date is not known, at least year you will be knowing. Take the FMV of the asset as on that date or as on that year. Because especially when it comes to inheritance and all, parents would have planned, but still assume, sir, suddenly they died. I don't know the cost of it. How will we do it? Cost of acquisition is zero, na? No. Whatever is the FMV of the asset when the asset was purchased by the parents. Next, where the shares in the amalgamated company, which is an Indian company, become the property of the assessee in consideration of the transfer of shares in the amalgamating company. Amalgamating company means the company which got closed. Maruti in my example. Amalgamated company means the new company. In my example, it would be Maruti Suzuki, guys. Yes. So, the cost of acquisition of the shares in the amalgamating company. I had purchased the shares in Maruti, no? That will become the cost of acquisition for the shares of Maruti Suzuki, guys. Next, where the capital asset become the property of an assessee on the distribution of capital assets of the company on liquidation. Mr. A got the capital assets from the company, na? Yes. If he transfer it in future, what is the cost of acquisition for it? FMV. Because when he received, did we compute capital gains? Yes. To compute capital gains, what did we take as full value of sale consideration? FMV of the asset. So if the asset received, if it is sold in the future, then what is the cost of acquisition? FMV of the asset when it was received. Guys, please be careful. There will be two capital gains computed here. For the shareholder, when he received the asset, is it a transfer? Yes. Why? Because he has surrendered the share and received the asset. What will be the full value of sale consideration? The FMV of the asset received or the money. Now, whatever asset he has received, what if we sell it in the future? Will we compute capital gains again? Yes. What is the cost of acquisition? The FMV of the asset on the date of receiving it at the time of liquidation. Okay, so next, where the capital gain arising from the transfer of specified security or security shares referred to in section 17.2. What would be the cost of acquisition? FMV on the date of exercising the option. When I was covering ESOP provision under salary aid, I mentioned this. Clear? So assume the FMV of the share was 500. Employee paid 200 and purchased the share. What is the discount for him? 300. Is it taxable under the head of salary as per Quizet? Yes. If he sell these shares in the future, what is the cost of acquisition for him? 500. 500, guys. Next, this is with respect to gift taxation. Sir, when I have received the asset freely or I have purchased it for a lower value, stamp duty value or fair market value will be considered for me to compute the income under the head other sources? Yes. And if I sell this asset in the future, what would be my cost? The cost which I have actually paid or the FMV or stamp duty value? FMV or stamp duty value. Stamp duty value for immovable property, FMV for specified movable property. Whatever would have been considered to compute the income under the head or income from other sources as per section 56 to 10. Oh. Then this gold receipts, I have already explained you guys that 5 lakh in my example. Then right shares. I was already the shareholder of a company. They gave me a right to purchase the shares. If I use this right and purchase the share, whatever I am paying to the company will be my cost. Listen guys, listen. Now, I was holding the shares of, assume TCS Limited. I was already holding the shares of TCS guys. Vikas was already holding the shares in TCS. Now, TCS Limited gave me a right to purchase 10 shares at 2000. I'm just taking random figure. Whereas the market price is much more than this. Okay, assume the market price is 2500. Yes, sir. Now, if I use this right and purchase the share, what is the cost of acquisition for me? 2000. 2000. Now, no, I already have a shares in TCS. I thought, let me not use this right. I am selling this right to you. I am selling this right to you. I sold this right to you for 100 rupees per share. For the sale of right, is it taxable for me? Yes, 100 rupees. No cost because I have not incurred any cost to purchase this right. Straight away sale value is 100 rupees. Okay. Now let me write as you only, paid 100 rupees for me, plus you will pay 2000 for the company to purchase the share using the right. Agree, you paid 100 rupees to purchase the right from me, plus 2000 for the company to purchase the share. What is the cost to you? 2000 plus 100 per share. Per share. Hope you guys are getting it. We call it as a renouncing right. I didn't use the right. I renounced it to you. So for you, what would be the cost? The cost which you have incurred to purchase the right plus the cost which you have incurred to purchase the shares. Yeah. Next, bonus shares, if they are allotted, guys, company will always give the bonus shares free of cost. But if it is given before 1st April 2001, which is a standard date, base year is 2001 too, na? Standard date is 1st April 2001. Okay. Then the cost of acquisition would be actual cost, which is actually nil, or the FMV as on 1st April 2001, whichever is higher. Straight away you can take FMV only. Why? Because cost is always nil for bonus shares. Nil with FMV, whichever is higher, definitely FMV. Okay. Sir, what if bonus shares are allotted on or after 1st April 2001? Then take only actual cost, which is nil. Which is nil. Then, if it is the listed shares on which bonus shares are given before 1st February 2018, on which STT is paid, then what is the cost of acquisition of this bonus shares, sir? It would be higher of actual cost, or second point, lower of FMV as on 31st Jan or actual sale consideration. So what you do is go reverse. First calculate lower of FMV and actual sale consideration. Compare that with actual cost. Take whichever is higher. Whichever is higher. This is as per which section? 112A guys. That is for bonus shares. Sir, what if it is EFT? EFT is covered under 112A. They don't give indexation for it. But if this EFT was purchased before 1st February 2018, guys, because 112A was brought into effect from 1st February 2018. Say they told, if you have purchased EFT before 1st February 2018, claim the cost like this. How is it, sir? First to take FMV as on 31st January 2018, which will be given in the question, or the actual sale consideration, whichever is lower. Compare that with your actual cost of purchase. Take whichever is higher. Whichever is higher, guys. Yes, this is only if you have purchased EFT before 1st February 2018. Sir, what if I have purchased on or after 1st February 2018? Then claim only actual cost. Then claim only actual cost. No higher, no lower, nothing. Only actual cost. Okay, sir. Next, if no cost has been incurred for acquisition, then it will be taken as nil. That is in any other case. See, in case of gift and all, sir, I have not incurred any cost. Still, we are taking what? Cost of previous owner. But if there is any other case which is not covered in this table, you are not paid anything to purchase the asset. What will be the cost to you? Nil. Okay. No deduction for STT paid, guys. For STT paid. No deduction for STT paid under that capital gains. But if buying and selling securities is your business and that income is taxable under the PGBP, sir, under the PGBP, can I claim deduction for STT? Yes, you can claim. But if securities is a capital asset for you, when you have transferred it, if it is taxable under that capital gains, then no deduction for STT. No deduction for STT, guys. Oh. Then notional transfer of goodwill on admission or retirement of a partner is not chargeable to tax, because you guys would have learnt in your accounts at the time of admission, retirement, death and all, we do a lot of adjustment for goodwill. Sir, is it considered to be a transfer? Is it liable for capital gains? No. Next. Sir, in case of gift will partition and all, I have already explained this, guys. Conversion of preference shares or debentures into equity shares. I have already explained it along with the example. Next, any compensation or enhanced compensation received by an individual or HUF on compulsory acquisition of agriculture land in a specified area, which is urban area, is exempt under section 1037. Sir, what if agriculture land is in not a specified area? It is not at all a capital asset. It is not at all a capital asset. Here they are talking about what? The agriculture land which is in urban area, which is specified area. If it is transferred by individual or HUF and it was used before, means before transfer at least for 2 years for agriculture purpose, means they enjoy the exemption under section 10 clause 37. Okay. Next, sir, government acquired my property compulsorily and they fixed my compensation for 50 lakh. I didn't agree for it. I took government only to the court telling my property worth is 80 lakh, pay 80 lakh. And court gave a judgment that government should pay me 70 lakh. So compensation has been enhanced from 50 to 70. So for 20 lakh also should I pay tax? Yes. So normally this I will receive it later. Why? Because you know, by the time the judgment is given, it will be years together. So previously I would have already considered 50 lakh in my capital gains calculation. Next, when I receive enhanced part 20 lakh, is it taxable? Yes, in the year in which I receive it. Can I again claim cost of acquisition? No, no. You cannot claim because you would have already claimed it while computing the capital gains when the compulsory acquisition happened, where you would have taken full value of sale consideration 50 lakh and you would have claimed full cost there. So when you receive the enhanced compensation, entire 20 lakh will be taxable under the capital gains in the year in which you receive it, and no cost will be allowed against it. No. Then redemption of preference shares amounts to transfer. And should we compute capital gains? Then yes. Next, guys, assume I was willing to sell my property to you. You came, gave some advance, but never came back. Can I forfeit that amount? Yes. But when I forfeit it, is it my income? Yes. Is it taxable? Yes. How? Depends on the date. Depends on the date. Advance money received and forfeited by the assessee, that is the present owner, where transfer did not take place. If the money is received before 1st April 2014, then the amount will be reduced from the cost of acquisition before indexation. Before indexation. Sir, what if the advance money is received and forfeited on or after 1st April 2014? In the year in which you have received and forfeited itself, it will be taxable under the head other sources. Sir, will it be again reduced from the cost? No, no. Only one year. So you have to be careful with the date, guys. Actually, this is a part of income from other sources. Okay, sir. Now coming to some special transactions. Some special transactions. First, buyback of shares. If a company has bought back the shares, then is it a capital gains income for the shareholder? Yes, because his shares he has transferred it. Is it a capital gains income for him? Yes. Now let us see how is it taxable. Guys, please pay attention. First category of shares I will take ESOP shares. ESOP shares. Buyback of specified securities by any company, which is specified security here means what? ESOP shares. It is taxable in the hands of whom? Shareholder. As what? Capital gains income. For him, what will be the sale price? Buyback price. whatever price he has received from the company. And capital gains calculation will be as usual, whatever we have already discussed. Okay, so next, if buyback of share is by a domestic company other than ESOP shares, by a domestic company other than ESOP shares, then if it is before 1st October 2024, company was liable to pay tax on capital gains income of the shareholder. At what rate, sir? 20% plus 12% surcharge plus 4% cess. Effectively, the rate was 23.296 percentage. Who is paying tax? Company. On whose income? Shareholders' income. Any income? No. Capital gains income, what shareholder has earned from the buyback of shares. From the buyback of shares, guys. Okay. And when company has paid tax on this capital gains income of the shareholder, for the shareholder, it is exempt under section 1034A. Okay. But from 1st October of our previous year, they have changed the provision, which is an amendment, guys. Amendment. If the buyback of shares other than ESOP shares has happened by domestic company on or after 1st October, then whatever buyback price the shareholder will receive is taxable as income from other sources fully as per section 222 deemed dividend. Sir, can he claim any expenditure? No. Can he claim cost of acquisition? No. But under the head capital gains, cost will become a loss. Whatever is his cost of acquisition is there now, that becomes loss for him. That becomes loss. Which loss? Either short-term loss or long-term loss. Can he adjust it against the gains? Yes. Short-term loss can be adjusted against short-term gain or long-term gain. Or if it is a long-term loss, it can be adjusted only against long-term gain, guys. Long-term gain. Yes. So please be careful with this because this is an amendment. This is also covered in the income from other sources. Where is it taxable means section 222, which is deemed dividend, guys. What is taxable is buyback price wholly. Okay. Sir, what if the buyback of shares is by any company other than domestic company, other than ESOP shares? Then it is always taxable in the hands of shareholder, guys. It is always taxable in the hands of shareholder. So please be careful. Change is only when the buyback is made by domestic company, the amendment part. Okay. Next. Guys, whenever we are using the asset for business purpose, we claim depreciation on that asset. But every assessee is supposed to follow WDV method, that is to claim depreciation on block basis. If any one or two assets are sold from the block, then we will just reduce the sale value from the block and compute depreciation. But depreciation under section 32 fails in two scenarios. That is, when all the assets in the block are sold, there is no asset to claim depreciation in the block. Or there is no value in the block. Sir, assets are there, but WDV for the purpose of depreciation is negative, sir. How can we claim depreciation on negative value? Not possible. So in that case, section 32 will fail. Immediately section 50 will take over to compute short-term capital gain or short-term capital loss. And when we are calculating here, irrespective of the period of holding, it will always be short-term, guys. And they have given the format here, which is just like reverse of whatever format we would have seen for WDV calculation. Come on, let us recall. How do we calculate WDV for the purpose of computing depreciation? Opening WDV as on 1st April plus asset acquired and put to use for more than or equal to 180 days. Let's next plus one more asset acquired and put to use for less than 180 days during the previous year. Then sale value. You will get WDV for the purpose of depreciation. From that you will claim depreciation. Here as per section 50. Full value of sale consideration minus expenses on transfer, opening return on value, addition to the block if any, means before selling it if you have purchased any asset. Okay. Then you will get short-term capital gain or loss. If this figure is positive, then gain. If the figure is negative, then it is loss, guys. That's all. Then coming to 50 double A covers three assets. It was two before, but now it covers three assets. It is always short term. Short term capital gain in case of transfer of units of a specified mutual fund acquired on or after 1st April 2023, or a market-linked debenture, an unlisted bond or unlisted debentures, which is transferred or redeemed or matures on or after 23rd July. How do we compute it? So the format. Full value of sale consideration or the redemption or maturity value, one and the same. Less expenses on transfer or redemption or maturity. Net sale consideration, from that you reduce cost of acquisition and improvement. And in the law they have given the format as improvement also, but in my opinion, for these three assets, there won't be any improvement cost and all. Clear? Just so. So you will get short-term capital gain or loss. Guys, please be careful. Both this, whatever you calculate under section 50 and 50AA, are always short-term in nature. And it is normal income. Sir, is it a part of 111A? No. It is a normal income taxable at normal rate as applicable to the assessee. And can I claim STT as a deduction here, sir? No. No deduction for STT under capital gains set, guys. Remember, like. Oh, next, slump sale under section 50B. Sir, my business was boring for me. What it was? Boring. So I sold entire business or undertaking. Entire business or undertaking, I sold it without giving values to individual asset. In your accounts and all, you would have decided purchase consideration. Sir, entire business has been sold to. Correct. eBay has been sold to Google and they named it as Google. eBay has been sold to Google and they named it as Google. Yes, sir. Now, what is it a transfer? Yes. Should we compute capital gains on each and every asset? No, because all the assets of eBay will become now the assets of what? Google or Google. Correct? Yes, sir. Now they told we consider this as a slump sale. Slump sale. So compute one capital gains for the entire business or for the entire undertaking. So what is the capital asset here? Entire undertaking or a business. If you have held it for more than 36 months before transfer, it is a long term. If you have held it for less than or equal to 36 months, short term. Clear? What are the provisions? We will see first. Slump sale is a sale where the assessee transfers one or more undertaking as a whole, including all the assets and liabilities as a going concern. We are not liquidating the business. We are selling it as a going concern. The capital asset is the undertaking itself, and therefore, if it is held for more than 36 months, it is a long term. If not, it is a short term, guys. Next, the fair market value of the capital asset as on the date of transfer shall be deemed to be the full value of sale consideration. But there are two FMV here. We have to take whichever is higher. What are those, sir? FMV1 being the fair market value of the capital assets transferred. FMV2 is the value what we have got. The value what we have got, which is nothing but purchase consideration. The value of the asset which I have transferred or the value what I have got. Normally it will be in money or sometimes it might be in kind also. Assume the Google has given me the shares in Google or Google. So it is consideration in kind, na? Yes, sir. So in that case, we have to take the value of. So in simple, guys, value of the assets which I gave or the value what I got, whichever is higher. Whichever is higher. What is it? Full value of sale consideration. Then no indexation is available under section 50B. Then what would be the cost of acquisition? It would be the net worth of the undertaking as on the date of transfer based on book value. If any asset is revalued upward or downward, cancel that revaluation. Take it at book value. Take it at book value. Guys, as they are taking the net worth of the business as on the date of transfer, they are not giving you indexation. Even though the asset is long term, they are not giving you indexation because what? They are taking the current values, net worth as on the date of transfer. Revaluation of asset will be ignored. So what is the format to compute, guys? What is the format to compute? Full value of sale consideration, that is higher of FMV1 or FMV2. Then expenses on transfer we will reduce. We will get net sale consideration. Then we will reduce cost of acquisition. No indexation even though the asset is long term. What is that cost of acquisition? Net worth on the date of transfer. So we will get taxable long term or short term capital gain, guys. Long term or short term capital gain. Yes, so. Next 50C. 50C is a special provision applicable only when the capital asset is a land or building or both. In case if the transfer of capital asset being a land or building or both, there is a high chances of price manipulation, guys. There is a high chances of price manipulation. You guys also would have encountered few scenarios like this. Okay, property would have sold for 1 crore, but in the agreement they will show only 60 lakh, 50 lakh, 40 lakh like that. So in order to tackle that, they have included section 50C under the head capital gains. What is it? If land or building is transferred for a price which is more than stamp duty value, straight away take actual sale value as full value of sale consideration. Sir, what if sale value is less than stamp duty value? Up to 10% difference means okay. If the difference is more than 10%, guys, means if stamp duty value is more than 110% of actual sale value, then we will take stamp duty value as full value of sale consideration to compute capital gains income. Now assume the sale value was 50 lakh, stamp duty value was 60 lakh. So stamp duty value, is it more than 110% of sale value? Yes, sir. Because sale value is how much, guys? 50. 50, yes, sir. Now 110% of this comes to 55 lakh. But stamp duty value I told us 60 lakh. So is 60 more than 55 lakh? Yes. How much is the full value of sale consideration now? 60 lakh. Now the assessee is labo. No, sir, my stamp duty value is not 60 lakh. My property value is not 60 lakh. He requested the assessing officer, sir, please cross check again. Now assessing officer may refer this case to the valuation officer. And valuation officer will value the property and he will give the value now. Now assume he gave the value more than stamp duty value. What will the assessee will do? Sir, I will follow stamp duty value only. Sir, I am okay with stamp duty value. Full value of sale consideration will be what? Stamp duty value. Agree na? No, no, sir. As valuation officer gave the value less than stamp duty value. Assume he gave it as 57 lakh. 57 lakh. What will be the full value of sale consideration? 57 lakh. 57 lakh. So I have just given it as a table here. You can observe. Actual sale consideration more than stamp duty value means we will take actual sale consideration only. Or else if stamp duty value is more than 110% of actual sale value, then we will take what? Stamp duty value as full value of sale consideration. Sir, what if the difference between sale value and stamp duty value is within 10%? Okay, we are accepting it because up to 10% difference is allowed, sir. If it is more than that, no, we don't. Okay. Then if this may not come always, only if assessee has requested for it. If the case is referred to the valuation officer, and if valuation officer gave the value which is more than stamp duty value, then we will take what? Stamp duty value. Or else the valuation officer's value is less than stamp duty value, we will take what? Valuation officer's value, guys. Now stamp duty value, whatever we took for comparison purpose, it is on the date of transfer, guys. Sir, what if the date of agreement and date of registration is different? We can take the stamp duty value on the date of agreement, provided at least a part of the consideration is received in any mode other than cash. In what mode should I receive? Rule 6 A, B, B, A above. Clear, huh? Sir, what if nothing is received or I have received but in cash? Then you have to consider stamp duty value on the date of registration. Okay, sir. Same to same provisions is applicable under section 43CA under the head PGPP. But when land or building is a stock for same to same, because when I've sold the land or building, it is taxable under the head PGPP for me if it is a stock. While calculating the income under the head PGPP, should I take actual sale value or stamp duty value and all? Same to same provision, but under section 43CA under which head? PGPP. So it is simple. Whenever it is land or building, guys, which asset we are talking about? Land, building, or both also. So there are two possibilities. There are two possibilities. First, check, is it a stock or capital asset? If it is a stock, which head is applicable? PGBP. To compute the income under the head PGBP, which section should we apply? Section 43 CA. If it is a capital asset, then which head is applicable? Capital gains. To compute capital gains income, which section should we apply? Section 50C, guys. 50C. This is from whose point of view? Hello? From whose point of view? Seller point of view. From buyer point of view also there is a checkmate. Which section should we check? 56 to 10. From recipient point of view, provided it is only capital asset for him. Only if it is a capital asset for him. Correct? Yes, which is covered in section, which is covered under the head income from other sources. Okay, this is from buyer point of view. Buyer point of view, guys. Provided it is only capital asset for him. Whereas for the seller, whether it is stock or capital asset, provisions are applicable, but under the different head and different sections. Okay, now coming to indexation, guys. One of the key important things for your syllabus, where there is an amendment. So please pay attention. I have just made one table for it. Summary showing the indexation benefit available to different types of long-term capital assets which are transferred before 23rd July. Long-term only before 23rd July we are discussing, because on or after 23rd July, madam has actually made it easy. So if the long-term capital asset which are transferred before 23rd July 2024, then if it is a bonds or debenture, no indexation. If it is a capital index bonds or sovereign gold bonds, indexation is available. We discussed about it already. Clear? Yes, sir. Next, if it is a depreciable assets, we always compute short-term gain or loss under section 50, where section 32 fails. Then if it is a unit of specified mutual fund or market linked debenture, for which we compute gain under section 50 AA, always short. Sir, one more item you have not given, because it came only on or after 23rd July. Okay, that is why I am not given it here. Then in case of EFT, guys, EFT, we will always compute long-term gain under section 112A. That is, it can be short-term also, but we are talking about indexation. Obviously, it is for long-term assets. That's why. And here, why did you mention here, sir? Because for this, we never check period of holding at all. We don't check period of holding at all, guys. Okay. So when we compute long-term capital gain under section 112A, no indexation. But please be careful. There is some pattern of calculating cost only if it is purchased before 1st February 2018. If EFT is purchased on or after 1st February 2018, then your actual cost is your cost of acquisition. Then for any other long-term capital asset, was indexation available? Yes, sir. Now the crucial point, guys. Amended point. As per section 48, no indexation benefit is allowable on long-term capital gains arising on transfer of any capital assets taking place on or after 23rd July. Except, means for the following indexation is available? Yes. Except land and building transferred by resident individual or HF, on which indexation is optional at the benefit of assessee. Catch point. One catch point is here. I kept on telling this. I will cover it. The point has come. An individual or HF, while computing tax on long-term capital gain on transfer of land or building or both, has the option to take the benefit of indexation under section 112 in respect of long-term capital gains arising on transfer of land or building or both, which is acquired before 23rd July and transferred on or after 23rd July. Guys, for this provisions to apply, first of all, for any transfer of capital asset made on or after 23rd July, no indexation. Only in one case indexation is available. Which are those? Conditions are there. What is asset transferred? Land or building. Who has transferred it? Resident individual or HF. When it was purchased? Before 23rd July. When it is transferred? On or after 23rd July. Yes, sir. Indexation is optional. But indexation is available only while computing capital gains. Look at the twist given by the madam here. She told indexation is available for you at optional only while computing tax liability. That means to compute capital gains income to be included under that capital gains while computing total income. Do we have indexation? No, we don't have indexation. We don't have indexation. Let me explain this with an example. Guys, listen here. Sir, assume my sale value. Okay, let me change. My sale value is 80 lakh. My sale value is 80 lakh. Actual cost of acquisition is only 30 lakh. Actual cost of acquisition is only 30 lakh. Now, this is a land or building transferred on or after 23rd July, guys. Land or building transferred by resident individual on or after 23rd July. First, we have to compute long-term asset. Assume long-term asset. First, we have to reduce only cost of acquisition. How much? 30 lakh. Assume no other cost, nothing is there. So, what is my gain? 50 lakh. Which gain? Long-term capital gain. Include this under the head capital gains to compute total income. Include entire 50 lakh. Sir, you told indexation. No indexation here. First, include entire 50 lakh under the head capital gains. Is that clear? Yes. Finish total income calculation. Now come for tax liability calculation. There you have an option of indexation. There you have an option of indexation. So this is a long-term capital gain without indexation. Yes, sir. Then compute long-term capital gain with indexation also. Sale value is 80 lakh. So index cost of acquisition you claim. Assume it is coming to rough calculation I am taking. Assume it is coming to 60 lakh. 60 lakh double. Okay, sir. Now what is the long-term capital gain? With indexation. With indexation 20 lakh. Now you calculate the tax. Now you calculate the tax. With indexation, whatever you have got, on that what is the tax? 20%. Or else, without indexation, whatever you have got, what is the tax rate on it? 12.5%. So should I pay both? No, whichever is lower, go with it. Whichever is lower, go with it. Hope you guys are getting it. Clear? On 50 lakh, 12.5% or on 20 lakh, 20%. Whichever is lower, you will go with it. Whichever is lower, you will go with it. And on the remaining incomes and all, calculation continues to be same. Calculation continues to be same. Look at the twist given by the madam. She told indexation is available, but not the way it is available. Why? Because, guys, when you include the entire 50 lakh gain under the head capital gains to compute your total income, it may have some consequences on you. It may have some negative impact on you. What is it, sir? Your total income will shoot up. You will be covered under surcharge and all. You might be covered under surcharge and all. Correct now, because when your total income crosses 50 lakh, 1 crore, 2 crore and all, you will be liable to pay surcharge. The trick played by our madam G. Hope you guys got the point, what I tried to convey. Yes, important guys. I know most of the students would have not understood this amendment in this way. They would have taught it, oh, long-term gain with indexation or without indexation, whichever is lower, take that in capital gains income calculation. No, 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 no. That is not what the government meant. Clear? So somewhere if they want to keep the question complicated in this attempt, this area will be targeted, guys. This area will be targeted. Yes. Later, I am also thinking to discuss the questions on it, but not in this video, in a separate video, guys. Let us do that later. But understand the provision now. I have anyway explained along with the example. Oh, important note. What is it? This is with respect to whatever I just now discussed. First, include the entire long-term capital gain without indexation on transfer of land or building or both in total income calculation. And while calculating the tax on long-term capital gain with and without indexation, and take whichever is lower. Whichever is lower, guys. Just so. Now coming to tax rates. Guys, tax rates on capital gains income, I have already covered it in tax rate chapter. Did we cover? Yes, sir. I will only ask, I will only answer. Don't worry, you don't take any tension. Now, anyway, as I already discussed this in tax rate chapter through this table, I have made one chart. Where is this chart? Just a minute. This is not my handwriting, definitely. Concept is mine, handwriting is my wife's. Chalo. Listen, I have tried to simplify through this chart. Capital gain on the transfer of EFT, equity share listed on the recognized stock exchange. F, units of equity oriented fund, units of business trust. If it is a long term capital gain, then it is covered under section 112A, guys. Then the rate of tax depends on the date of transfer. The rate of tax depends on what? Date of transfer. If the date of transfer is between 1st April to 22nd July, then the rate of tax is 10% in excess of 1,25,000. Then if the date of transfer is between 23rd July to 31st March, then the rate of tax is on 12.5% on the amount of gain in excess of 1,25,000. So 1,25,000 is per annum, guys, not per each part. I have already explained this along with examples when I was doing tax rates. Yes, sir. Then what if the transfer on EFT is a short term, sir? Is it a special income? Yes, under section 111A. What is the tax rate? Again depends on what? Date of transfer. If the date of transfer is between 1st April to 22nd July, the rate of tax is 15%. If the date of transfer is between 23rd July to 31st March, then the rate of tax is 20%. It has been increased from 15 to 20 on the entire amount. On the entire amount. Sir, here they gave a benefit of 1,25,000. Illenu ilva? Eno illa. Okay. Note for both of this, securities transaction tax has to be paid, guys. That is, if it is E, it has to be paid both at the time of purchase and sale, whereas if it is EFT, at the time of transfer. Next, sir, what if it is a capital gain on the transfer of any other capital asset other than EFT? If it is the short term, guys, if it is a short term, always normal income taxable at normal rate. Very simple, sir. Normal income taxable at normal rate. Please be careful. Every short term gain is not a special. Only on the transfer of EFT. Okay, so what if it is a long term capital asset? It depends on the date of transfer. It depends on the date of transfer. If the date of transfer is between 1st April to 22nd July, there are three set of assets here. First set, unlisted securities. Who is the assessee? Non-corporate, non-resident or foreign company. The tax rate is 10% without indexation. If it is any other assessee, then it is 20% with indexation. Okay, sir. Second set of asset. Listed securities or zero coupon bonds. The tax rate is 10% without indexation or 20% with indexation, whichever is lower. Whichever is lower. Then last category, any other assets which is not covered in first and second, that is other than securities. Other than security. And obviously EFT also will not come here. EFT also will not come here. Just so. What is the tax rate? 20% on the gain with indexation. And guys, if by chance if question is silent and if the date of transfer is before 23rd July, please go with this. Please apply 20% on the gain with indexation. Next category. If the date of transfer is between 23rd July to 31st March, then check. If the asset transferred is land or building by a resident individual or HF, which was acquired before 23rd July, then tax rate is 12%, 12.5% on the gain without indexation or 20% on the gain with indexation, whichever is lower. And this is only while calculating tax. Only while calculating tax and not while calculating income. Please be careful. If it is any other assets or assessee, then it is 12.5% on the gain without indexation. No option, nothing. Okay, sir. This is all about the tax rates on capital gains income, guys. Coming back to our provisions. Common points for section 111A, 112 and 112A, guys. Now, if the assessee is a resident individual or resident HUF, and if their normal income taxable at normal rate is less than basic essential limit, then whatever is the shortfall, which we also called it as unexhausted basic essential limit. Sir, can I adjust it against capital gains to special income? Yes, you can adjust, provided you are a resident individual or HUF. Guys, listen here. Let me explain this with an example. Now assume I have a total income of 6 lakh. In that, long-term capital gain under section 112 is 4 lakhs, sir. Then normal income is 2 lakhs, sir. So assume I am following default regime. Basic essential limit is how much? 3 lakh. What is the shortfall, sir? 1 lakh. Can I adjust it against the long-term gain, special income? Yes, sir. Remaining 3 lakh, I will pay tax. Either at 12.5% or 20%, whatever is the case. Is that clear? And here, am I eligible for rebate also? Yes. Can I claim rebate? Yes. Against 112 tax, rebate is available. If it is 112A, not available. If it is 112A, not available. Hope you guys got it. Now, sir, what if I have all three capital gains income? 111A, 112, 112A. Adjust it against the highest rate. Because take the benefit. For example, let me quote that also. Assume I have a total income of, okay, first let me write total income, 10 lakh. Under that, my normal income is only 1 lakh. I am following default scheme, okay? Normal income is only 1 lakh. Long-term capital gain under section 112 is 4 lakh. Remaining is short-term capital gain under section 111A you consider. 111A is 5 lakh. Is 5 lakh. Okay, sir. Now, normal income is 1 lakh. Basic exemption limit, we know that it is 3 lakh under default regime. What is the shortfall? 2 lakh. This 2 lakh, can I adjust it against 4 lakh or 5 lakh, sir? Wherever tax is higher. Depends on the date of transfer also. Clear? Depends on the date of transfer. Let me just imagine. So here it is 12.5% and here it is 20%. Assuming the date of transfer is after 23rd July. So 2 lakh, where should I adjust? Where it is more beneficial for me? Here, guys. So remaining 3 lakh will be taxable at 20%. And here entire 4 lakh will be taxable at 12.5%. Is that clear? In the law, they are not given the order of setting off, but you should set off in the way it is most beneficial to the assessee. It is most beneficial to the assessee. Yes, sir. Next. Assessee is not entitled to claim any deductions under Chapter 6A from Section 80C to 80O against capital gains special income. Against capital gains special income, you cannot claim any Chapter 6A deductions. Then, when we were discussing surcharge also, I had mentioned this. Capital gains special income, if it is a part of my total income, what is the maximum surcharge which will be levied on this income? 15%. Even if my total income is crossing 2 crore, 5 crore and all, whatever tax we calculate on capital gains special income and dividend income, what is the maximum surcharge? 15%. STT paid is not allowed as an expenditure, guys. Next, in respect of bonds or debenture, whether listed or unlisted, transferred before 23rd July, the resultant capital gains will be considered either as long term or short term based on what? Period of holding. But even if it is a long term, can I claim indexation? No. Because on bonds and debenture, indexation was not allowed. But should I classify if it is transferred before 23rd July as long term or short term? Yes. But if it is unlisted debentures or bonds, if it is transferred on or after 23rd July, then the resultant gain will always be short term. Don't even check period of holding. Don't even check period of holding. And indexation benefit in any case not available for bonds or debentures, even if it is transferred before 23rd July. If it is transferred before 23rd July, we may decide whether it is long term or short term. But even if it is long term, indexation is not available. But if it is unlisted bonds or debenture transferred after 23rd July, we don't care about period of holding only. It is always short-term gain under section 50 AA. Okay. We discussed all about gain. Sir, what in the process of gain if I have a loss? Definitely there is a possibility where my cost itself is more. So if there is a short-term loss or short-term loss or long-term loss, How do I adjust it? Very simple, guys. Loss under the head capital gains can never go outside the head. Can never go outside the head. If it is a short-term loss, adjust it either against short-term gain or long-term gain. Or you carry forward for next 8 years. Even when you carry forward, you can adjust only within the same head. Next, if it is a long-term loss can be adjusted only against long-term gain. If not, carry forward it for next 8 years. When you carry forward also, same story. So keep it simple. Capital gains loss, even though it is a current year loss, it can never go outside the head. It can never go outside the head, guys. Next, and one more thing. There is no impact of section 115 BAC on capital gains hit. Whatever is allowed, whatever is there, everything can be claimed, whether the assessee is following default scheme or optional scheme. So this is the one head where there is no impact, negative impact. In fact, there is no negative impact of section 115 BAC for the assessee, guys. Okay. Now coming to, sir, when we were discussing the format, you told if exemption information is available, we have to consider it and we have to claim it. We have to consider and claim it. Yes, sir, I told. That is only when question is specifying about it. That is, whatever gross gain I have, whether short term or long term, if I have reinvested it in a new asset within the specified time given in the respective section, I can claim the exemption. I can claim the exemption, and most of the section will tell what is the amount of exemption, means the cost of new asset or the gross gain, whichever is lower, guys, except 54F. Except 54F. So the gross gain or the cost of new asset, whichever is lower is the exemption. Means in simple, you cannot claim the exemption more than gross gain. Gross gain. So please take care of exemption only when question specifies about it. Okay, sir. We will take care. You take care of yourselves. Sure. Coming to the exemption, I have made it very simple in this table, guys. Very simple, provided you already have complete knowledge of it. Clear? And here also you will be able to get an idea. Don't. Guys, while checking the exemption, few things which we have to keep in mind. Which is the asset I have transferred? Which is the asset which I have to purchase? Within what time? Within what time? And once I purchase the new asset, what is the lock-in period for it? How long I cannot sell it, guys? Fine, we will see that. Exemption available in computation of capital gains. First, section 54. Applicable only for individual and HF. What asset is sold, sir? Long-term residential house. Which is the new asset purchase, sir? Residential house. Within what time, sir? If it is a purchase 1 year before or 2 years after the date of transfer. If it is a construction, within 3 years from the date of transfer. Hope you are understanding that math minus so plus so. For purchase 1 year before or within 2 years from the date of transfer. If it is a construction plus 3 years I have mentioned, means within 3 years from the date of transfer. Okay, sir. Maximum exemption would be 10 crore. Sir, I have purchased a new residential house for 15 crore, sir. Cost is restricted to only 10 crore. Only 10 crore. Yes, sir. I will just show you. Just a minute, guys. This is a part of my regular provision book, but still just an example I will take and explain you. Yeah, you can observe you. Gross long-term gain, assume 2.05 crore and cost of new asset is 3 crore. How much we will take here? 3 crore only. What is the exemption available? Gross gain or 3 crore, whichever is lower. 2.05. 2.05. Next, sir, cost of new asset is 1.55. 1.55 compare with 10 crore. Take whichever is lower because cost is maximum restricted to 10 crore. So here it is only 1.55 crore. Compare this to 2.05 and 1.55. How much exemption I can claim? Only 1.55, which is lower. Okay. Next, actual cost is 12 crore. So how much should I take? Only 10 crore. Now compare 10 crore with 7 crore. Whichever is lower is exemption. 7 crore. Next, Actual cost is 15 crore. 15 crore or 10 crore, whichever is lower, 10 crore. Compare this with 12 crore, whichever is lower, 10 crore. Allowed as exemption. Allowed as exemption, guys. Yes, sir. Next, 54B, which who can claim exemption here? Individual or HF. Which is the asset sold? Agriculture land. And at least 2 years before the transfer, it should be used for agriculture purpose, guys. Then, which is the new asset purchased? Agriculture land, sir. Within what time it has to be purchased? Within 2 years from the date of transfer. Next, 54D. For whom it is applicable? Geniuses. Geniuses. What has happened, sir? Compulsory acquisition of land or building, which is forming part of industrial undertaking. Now what should I purchase, sir? New land or building, which is forming part of industrial undertaking for my own business. Here also the condition is whatever land or building which is compulsory acquired now, at least 2 years before the transfer, it should have been used for industry purpose by the assessee. Now, within what time the new land or building should be purchased, sir? Within 3 years from the date of transfer. Then 54 EC. Any assessee can claim deduction exemption here. Which is the asset transferred? Long-term capital asset being land or building or both. Now, what is the new asset I should purchase? Specified bonds of REC, PFC, IRFC or NHEI. Within what time, sir? Within 6 months from the date of transfer. And here also, guys, there is a maximum exemption available, which is only 50 lakhs. Which is only 50 lakh. Maximum exemption under section 54 EC. Yes, sir. Under all these sections, guys, under all this section, what is the amount of exemption, sir? The cost of new asset or the gross gain, whichever is lower. Whichever is lower. Then 54F, applicable for individual and HF, which is the asset transferred, long-term capital asset, not being a residential house. What you have sold is not a residential house. But what new asset you are purchasing is a residential house. Within what time, sir? Same like 54, guys. Same like 54. Please be careful. 54 is from residential house to residential house. Whereas here it is not from residential house to residential house. But time limit and all is same. If it is purchased 1 year before or within 2 years from the date of transfer. If it is a construction, within 3 years from the date of transfer. Okay, sir. Here also maximum exemption is 10 crore, guys. Means if actual cost is more than 10 crore, we will restrict it to 10 crore. But here one twist is there. What does it means? Guys, you have to compare the cost of new asset with net sale consideration. You know net sale consideration in the format na? That is full value of sale consideration minus expenses on transfer. Compare the cost of new asset with the net sale consideration. If the cost of new asset is more than net sale consideration, then entire gross gain is exempt. Gross gain. Sir, what if the cost of new asset is less than the net sale consideration? Then only proportionate of gain is exempt. For which we have to use the formula, which I have made it. You can see here. If you want, you can also take down, make a note of it. 54F. When the cost of new asset is less than net sale consideration, what is the amount of exemption, sir? Cost of new asset divided by net sale consideration into gross long-term capital gain. Into gross long-term capital gain. Okay, sir. Next, let me just discuss one illustration. Any doubt? I will repeat the formula. This is only when the cost of new asset is less than the net sale consideration. The formula would be amount of exemption is equal to cost of new asset divided by net sale consideration into gross long-term capital gain. Gross long-term capital gain, guys. Yes, sir. This is only for 54F. Only for 54F. Let us discuss few illustration here. Guys, only for 54F, it is bit different. Please listen here. Listen. Things will change. First, let us take the cost or 10 crore, whichever is lower. Cost or 10 crore, whichever is lower, 4 crore. Here 1.75 or 10 crore, whichever is lower, 1.75. 12 or 10, whichever is lower, 10. 15 or 10, whichever is lower, 10. Okay, sir. Now compare. Now compare. While comparing, you will compare this with the net sale consideration. Okay, sir. Now listen. Is 4 crore more than 3 crore? Yes. How much is exempt? Entire gross gain. Entire gross gain. Next. 1.75. We will compare with 4 crore. Is it more? No, less. How much is exempt, guys? How much is exempt? Listen here. Gross gain is how much? 2.05 divided by net sale consideration 4 crore into the cost of new asset 1.75. How much ever you get, that is the answer. Leave it, leave it. You need not calculate because we'll proceed further. Next, 10 crore. Is it less than 15 crore? Yes. Again, same math. What is the gross gain? 7 crore divided by net sale consideration 15 crore into cost 10 crore. 10 crore. Don't take 12. We have already restricted it to 10. Next, same way. So, 10 crore less than 20 crore. So, again, same calculation. What is the gross gain? 12 crore divided by net sale consideration 20 crore into cost of acquisition 10 crore. This would be the amount of exemption, guys. This would be the amount of exemptions. Hope it is clear for you. Let us move forward. Here also maximum exemption is 10 crore, which we already discussed. Some important shortcuts with respect to exemption, guys. Withdrawal of exemption means if the new asset is sold within certain time, then whatever exemption you would have already claimed will be withdrawn. In what pattern it would be withdrawn, we have to see. First, what is the lock-in period we will see. I have given it as a note, you can see. Lock-in period of a new asset is 5 years for section 54 EC. Whatever bonds you purchase, the lock-in period for it is 5 years. You cannot even pledge it for 5 years. Then for all other sections, the lock-in period for new asset what you have purchased is 3 years. If you have sold it within this lock-in period, then what, sir? For section 54 EC and F, if the new asset is sold within the specified period in the respective section, then the capital gains exempted earlier is taxable in the year of transfer of new asset. Guys, simple. 54 EC is the bonds and F is new residential house. If you have sold this within for bonds 5 years or for house within 3 years, then on the sale of new asset, you will compute capital gains? Yes, sir. For that, you also have to add whatever exemption you have claimed earlier will become gain now. So in the year of transfer of new asset, there will be two gain. One gain on the transfer of new asset and another is whatever exemption you have claimed earlier will now become taxable for you. Okay, sir. For other sections, for 54, 54B and 54D, you have to hold the new asset at least for 3 years. What if I have transferred it? If the new asset is sold within the specified period in the respective section, then the capital gains exempted earlier is reduced from cost of new asset while calculating the capital gains on the transfer of new asset. That is, when you have transferred a new asset within 3 years, you will compute capital gains on it? Yes. While computing the capital gains, you will claim cost of acquisition? Yes. But from actual cost of acquisition, reduce whatever exemption is already claimed earlier. Whatever exemption is already claimed earlier. Clear? Yes. So for example, okay, only for this at least one example, one illustration I will cover it. Yeah, you can see this is an example on section 54, guys, which has same provisions. Illustration 2. The gross long-term capital gains is 2 crore and the cost of new asset is 3 crore. So how much exemption you can claim? 2 crore. Correct. Now how much exemption you can claim? Cost or gross gain, whichever is lower. 2 crore. You have claimed it. Now new residential house you have purchased. You have to hold it for at least 3 years from the date of purchase. You have not held it. If the new asset was sold after 18 months for 5 crore, then short term, assuming it is before the 23rd July. So we have to compute short term capital gain, guys. What is the full value of sale consideration? 5 crore. From that, can I reduce cost of acquisition? Yes. Can I claim full 3 crore? No. My actual cost is 3 crore. But from that, whatever exemption I have already claimed, we have to reduce it. So what is the net cost now? 1 crore. So 5 crore minus 1 crore, 5 crore, 4 crore is the short-term capital gain. Did you understand? For these three sections, while computing the capital gains on the transfer of new asset within the specified period, from the cost, reduce the amount of exemption which is claimed earlier. Sir, what if by chance, if I had claimed entire 3 crore as exemption, then cost becomes zero for you. Cost becomes nil for you. Yes. So, next, applicability of sections. For individual and HUF, it is only 54, 54B and F. Whereas other section for everyone. Everyone includes individual HUF also. Next, type of asset transferred. That is the old asset which you have transferred. Which one should it be? Short term or long term? For 54 EC and F, they have clearly told long term. Whereas for other section, it is either long term or short term. But in my knowledge, wherever, especially guys, 54B if I take, 54B gives exemption for what? Agriculture land transferred. They put a condition that it should be at least used for 2 years before the transfer. The section is open for both long term or short term, but indirectly it is only for long. Why? Because they have put a condition that the land should be used at least for 2 years before the transfer for agriculture purpose. If you have used it for more than 24 months, automatically it will become long term. Automatically it will become long term. This is just a logical thinking, but still in the section they have made it open for both long term as well as short term, guys. Yes, this is all about revisions of capital gains head. I know it was a bit lengthy session, but still I have done it purposely because the major amendments are there in this head, guys. So I have tried to cover extensively whatever is possible, wherever students might get doubt. I have explained it along with examples, illustrations, so that you will have more clarity. So please give little extra importance for this head and do it, guys. Maybe one time, two time, if possible, multiple times also. With this, we will close this head of income.